look at the move that occurred prior to that and how long it took. This time, it's instead of being a handful of years, and let's say tripling in the price of the S&P 500, it's been an 8 to 9-fold increase in the S&P over 15 years, and an 18-fold advance in the NASDAQ 100. So you say, well, the economy's been strong. Well, or look at an M2 chart, money supply chart, and it's an upward parabolic curve, okay? But over the last 10, 15 years, it's been even more than normal. Plus, they took interest rates of 10 of those 15 years to zero. Free money. Hey, well, it's like drugs, okay? And so people made decisions, investment decisions, families expanded, bought a new house, factories built new wings to the factory, hired more employees. A lot of spending decisions and investment decisions were based on the price of money. Well, they were delusional, okay? And so when you make a decision that is based on a big error, sometimes the dues have to get paid. And I think the stock market is now topping. I think it is a major top. Just like if you look at the 2000 top, in fact, MSA, Momentum Structural Analysis, my company got bearish in January 2000, said, if you're in this market, be gone, okay? Well, what happened was it was a sell-off into February, but then it came back up, made a new high in March, marginal, but a new high, comfy, felt good. And then just went sideways for the rest of the year. Whereas it wouldn't go down, it didn't really go up. And it was 2001 before they finally started to collapse. And that was when the Fed started cutting rates, by the way. Fed started cutting rates in January of 2001, about 5 months off the peak monthly close in the S&P. And only then did the stock market start to implode. You would think more free money would be good, right? Okay. And in 2007, it's when they cut rates after a lengthy pause in rate hikes. In September of 2007, again, a laborious top, up, down, but just wouldn't explode, wouldn't collapse. In October, it made its new high, final new high, 3 weeks after that rate cut, and that was it. They cut rates all the way down, the market collapsed. Will we finally get a rate cut? And I don't think it's essential, but usually when you get a rate cut after a lengthy pause and the market's doing topping action, and our momentum work says it's topping, you can put a tombstone on the market. The rate cut marks the spot, okay? And so we have a president now who claims to be free market oriented and yet wants the government to artificially price money close to zero, and make everybody happy again. So anyway, whether he fires Powell or not, I don't think is really relevant. The Fed is itself irrelevant in the sense that they create the boom bust cycles by doing what you said, helicopter money. Okay. And this time they've done it even more than they ever have in history, starting in 2008, 9, 10, all the way, So they've created a monster. And when the monster starts to drop, they try to rescue it, but it never works. All they do is expand the money supply again, and it goes somewhere else. And you mentioned earlier in your talk, commodities. Yeah, that's one of the places it's going to go. Anyway, so I think the economy's headed south, but it will do it after the stock market starts to hemorrhage. And once the public realizes this new high was a trap, a bull trap, that's when emotion comes into play because people hurt and then they get emotional. And that's when you get the kind of market and environment that I expect to see. In part, the commodities have done this before, by the way, where the world's going into recession. And I don't know if we're going into recession or into depression, to tell you the truth. Money can flow into commodities. Now, most people say, well, that doesn't make any sense. How can industrial copper go up in a bad economy? Well, it does. Okay. You go back and look at 2007 and 8 in the commodity complex, they were soaring. Well, the stock market was doing nothing, and then look at the late 1970s is a good example. Stock market was a total wasteland for 10 years. In fact, you couldn't make any money in this. It just blew sideways after a drop. And commodities exploded during that time, following gold, by the way. They were lagged too, but they followed gold at that time. Commodities have not followed gold since 2015 to 2020. They continued down while gold doubled. Okay. But then in 2020, late, they exploded. Commodities came up off their low. When I say explode, I mean off of historically cheap lows. They didn't really get the high levels. Like the Bloomberg Commodity Index got up to 140. Well, heck, if you look back to 2008, it was 237. So it was like halfway back to the highs. And then it pulled back after 2022 high on commodities. But over the last 2 years, if you look at a Bloomberg Commodity Index chart, you'll see a dead sideways market. Not going down, not going up, comatose. but way above the low that it made in 2020. It's basing. We're watching some of the components, like copper's already behaving great. Platinum suddenly woken up. Crude oil is about $3 or $4 away from a massive upside breakout on momentum, not evident on price. And I think when that happens, part of the reason for that will be money flow by investors out of a risk low reward category, the stock market. Once they perceive that, it'll go somewhere else. And the commodities are definitely quiet. They're cheap. Therefore, less risk, more likely reward. And I think some of that money is going to flow there. It's already obviously flowing into gold. So anyway, those moves by gold to the upside and an upturn in commodities, I think will be fair. The acceleration in gold that I think we've now entered, and an upturn in commodities will likely be pretty much in sync with the stock market topping out for a final time.
So you mentioned gold and commodities, Michael, and so gold done quite well already, as you mentioned. And of course, we have a lot of structural issues. We have the deglobalization. People want to move away from the US currency because we've seen what happened with Russian assets. So the countries like China, if they want to do something that the West may not want them to do, they don't want to be dependent on the West. They want to own gold. But people, the generals, they're not involved yet. So that, of course, brings more optimism. If that does occur, that means there's a lot of more upside with the actual metal. But even with the miners, I believe, have even more opportunities. So what's your take on that, Michael?
Where we peaked in the summer of 2020 in that big surge. The miners and silver did better than gold in that surge. But since then, between 2020 and recent lows, the miners and silver, while they've gone up in price nicely, they've gone up a lot less than gold. So they've underperformed gold. Okay. Not like they're a bad place to be. It's just that they haven't matched them on the market. The technical evidence now is that when we monitor it, those spread relationships between silver and gold and the gold and silver miners versus gold is shifting, favoring them as opposed to gold. So if you'll look at just a simple price chart, which we look at secondarily, but in April, gold was where it is now. Sideways, up, down, but no real drops, just a sideways, dull situation. By the way, gold never, ever tops that way. It doesn't top with a quiet top. It tops with this peak and a collapse, okay? But anyway, so gold's gone sideways, cooling off. Silver's gone up during that time, especially the last 2-3 months. Miners, if you look at them, their behavior is quite independent of gold now. There'll be some days you'll have gold flat or down and they'll be up, which is highly unusual. And it's showing that some investors are starting to move money already into the miners, probably large portfolio managers who are maybe a little less enthused about the stock market nipping out a new high than the average guy is. And they're looking for alternative places to put the portfolios. And normally, if you go back and look at 2000 to 2002 bear market stocks, 2007 to 2009, T-bonds, in fact, could become like a hand grenade thrown into a small room here, the way they're behaving right now, because they're acting like you drop bonds right now, the T-bond futures, 30-year bonds, are trading in the 113, 112, near 112 right now. Okay. You get down around 110 again, which we've been before in recent months. You get down around 110, another couple of points, no big deal. It could start to implode in a way that causes the central bank and the central government to panic. Yeah, it's not one of the Fed's mandates, the inflation, quote unquote, and the job market, the economy. The federal debt is not one of their mandates, but it has to be because it's a time bomb and it's huge. And so you start to throw that guy off the cliff. One, it eliminates the alternative that always is there for money to move to, but it also panics the central bank into having to do something monetarily wise, whether it's one of their mandates or not. They have to save that market because it's their debt market. It's not somebody else's mortgage like in 2007, So we got real interesting times here. And I think it's compressing to the point where it could get volatile and violent quickly. At minimum, silver is likely in this surge. Right now, it got under 1% of the price of gold. In other words, you divide an ounce of silver into gold, it was less than 1% of an ounce of gold. It's now up to like 1.1, 1.14, something like that percent. It could easily go to 2% plus in a heartbeat. 2%, you divide an ounce of silver into an ounce of gold, has occurred 20 plus years in the past 50, meaning it's hardly abnormal to see silver at 2%. You don't even have to have dynamic market for it to be at 2%. And if you just went to 2%, that means silver doubles in relative value to gold, I think, by the end of the year. Wouldn't shock me. Well, it's, would you rather be in something that doubles, compared to the other? Or not? Okay, miners, not necessarily by this year, end of the year, but over the next year or so, I could see them tripling in relative value to gold. Now let's talk about gold. What's reasonable for gold here? And I've said this in quite a few interviews. If you go back 50 years and look at the 1980 bull peak, it was an 8-fold move from its prior bear low. Then go from 2000, 2001 lows, which was around $260 gold, to the 2011 high at 1920 was another 8-fold move on a ratio scale. Well, our low was 1,050 in 2015. That means $8,000, $9,000 just to match 2 prior bull market peaks. And this time, I argue, we have massively more dangerous, implosive, and explosive factors underway in all markets around the world. Government debt market, US stock market, far more massive situations with wave effects that should be more powerful even than those bull markets. And another thing I tell people is, I don't think gold's going to go up and make a peak and collapse again, in which case it's institutionalized. So it's different this time. It's far different, more dynamic, and the outcome's going to be different.
And from the technical perspective, Michael, do you pay attention to the silver to gold ratio, to the commitments of traders report?
Yeah. The ratio between silver and gold, yes, that is a technical factor. I'm not going to try to explain why does it do this or that. A lot of people like to have a reason. There are many reasons. The main reason driving silver and gold over the long term is the ongoing degradation in money, meaning the real value of fiat currencies is degrading and degrading and degrading. So gold goes up because it's money. Okay. It's really not going up. It's just all those money units are going down in real value. Okay. What else did you say about the? COT report. Yeah, that's one of my favorite things to ignore. Okay, I know a lot of people like to find something short term that causes them to be fearful or not be fearful. And a commitment of traders report showed a couple weeks ago, I think it was. I had 2 subscribers send me an email asking me, "Are you concerned about this?" And it showed that commercial side of the market was more heavily short than it's been in a long time. I didn't pay a lot of attention to compared to when and when. And I said, I don't care about that. There's a couple of reasons I don't. But first off, commercials normally are because they produce the product. Therefore, if they're short, they also may own the bullion coming out of their mines. And it could very well be that, let's say over the last year, a lot of them simply, it's a subjective decision, remember. The miner doesn't have to hedge, or he can hedge to whatever degree he wishes. It's a corporate decision. A lot of these miners may have simply said, hey, man, silver's going up, and I kind of want to let it go because I want to make some money. I don't want to lock in a low price, when I might make a lot more by letting it run and not hedge it. So maybe they rode the last year up only 50% hedge, let's say, because they sort of collectively thought, hey, I'm going to make some money, and they did. Okay. But then silver got up to 37 or so, a few weeks ago. Now it's 38, 39, and it paused for a while. Maybe they decided then, let's hedge here. And so suddenly you had a shift from less hedged to more hedged, and that caused that number to jump. And another opinion of mine is, and I learned this a long time ago when I got in business, 1975, I got hired by E.F. Hutton, commodity division in New York, the headquarters. And chairman of the COMEX was also the head of Hutton's commodity department. And I apprenticed under him. I didn't know anything about technical analysis. And back then, I was sitting at the metals desk at Hutton, which was primarily a trading desk for copper miners that would hedge through Hutton. Okay. And a copper miner came in, a corporate CEO of a company that underwent almost bankruptcy in the prior year, I think it was, where he had decided, the head of the company had decided not only to hedge, but to go short. So to have more than a short hedge position in copper, because he thought it was just too high priced and ridiculous and so forth, thought he could make some money. It almost took his company under because there was a spike at the tail end of that bull trend where, because of him primarily, he sat down next to me waiting to talk to the head of the department and said, I created that spike, me covering shorts to keep my company from going under because he was overly hedged. And which I remembered. And so when these people sent me that COT report information a week ago, I recalled that meeting, that meeting with that guy, and realized, sometimes people in the industry aren't necessarily smarter than the average guy. They're human beings. They may know how to get copper out of the ground and how to refine it, but they don't necessarily know about market trends and how to analyze them. And so the fact that they might be more heavily short doesn't prove anything to me about what's going to happen to the market. They're not always right. Okay. Anyway, enough said.
Yeah, that's a very interesting perspective. So Michael, what's your opinion on uranium? Are you interested at all at these levels?
We got bullish on uranium. Was it 2018 based on annual momentum of uranium? Uranium then was like $20. Okay, and we got bullish, and first time we ever got skeptical and thought a correction could occur was August of last year. Uranium had been over 100, was dropping back to 85. And at 85, we said, watch out, it's going to correct. And it could drop, under 70. Well, it got down to the mid 60s. And I think it's still laboring either side of 70 for the last handful of months. I think it's basing. I think the correction's over. I'm not quite sure when it's going to resurrect itself and put on another up leg. I don't have that much interest in it. It had a massive move, a quintupling in price from 2018 to 23. Nice move. So it's in a new price reality now, where if it was vastly underpriced, it no longer is vastly underpriced. That doesn't mean it can't go up. It just says, hey, that was the game. Yeah, it might go up again. And we don't see it as being risky owning it here, nor the URA, for example, which is the ETF of the miners, the producers of uranium. But I don't see it as a primary place to be. It looks safe enough to own. It's likely to go up from here, but you want to be in silver and gold and silver miners if you're looking for percentage gain.